Hi everyone, welcome to my latest podcast. Today we're going to look at the buy-to-let market. As you know, there's been much coverage on this sector. We've seen many amateur landlords pulling out of this market. And what's happening with portfolio landlords? Another question, where do we see interest rates going? What impact have the changes announced in September by the government had on the landlords and tenants? These are just a few of my thoughts. And to discuss these and the buy-to-let market in general, I have Wes Regis, Key Account Manager at Fleet Mortgages. Welcome, Wes.
Hi, Anita.
I'd like to start, Wes, by asking what's happened this year in the buy-to-let sector?
Well, it's been a challenging year, I think is the correct word to use.
Yeah.
We knew it was going to be. I mean, even if you looked at UK Finance's forecasts at the back end of 2022, the industry as a whole knew that this year, compared to last year, was going to be a more subdued buy-to-let market, to say the least. I think the UK finance forecasts were around about 30% down overall year on year in terms of actual gross lending.
Yes.
And that for once, forecasts are always very, very hard finger in the air type jobs. But for once, this was a forecast that seems to be very accurate. I mean, that is anecdotally speaking to brokers, speaking to other lenders, speaking to mortgage distribution, that does feel to be around about the ballpark. Down that we are this year compared to last year. Speaking selfishly about Fleet's performance just for one moment, I don't think we've seen a drop quite as high as that across the market. I think we're year on year, we're about 20-25% down in terms of gross lending. But I think one of the biggest things that's actually impacted that figure isn't necessarily a significantly lower number of transactions. I think the affordability challenge that we've seen in the buy-to-let space has meant that average loan sizes are quite significantly reduced. So in terms of number of transactions, there's still a fair bit of opportunity out there, and probably more than a lot of people realise. But the loans that are being written and the loans that are being completed are actually, on average, a lot lower than this time last year. And it's all about the affordability side of things.
Yeah, I totally agree with you on the affordability side of things. But I think, this year, as you say, it's been a bit unprecedented what's been happening. But how do you see next year, Wes? Can you see the market picking up? Especially, I suppose, where I'm coming from here is sort of like the specialist lender side, because I think more than ever, it's the specialist lender, I think, who will fit nicely in with our advisors and their clients.
Yeah, I think you're right. So in terms of the broker world and the advice that's going to be needed out there in the real world, I think specialist lending is going to become more and more important for a lot of reasons. Obviously, we're probably going to see an increase in adverse type applications. So you're going to need the specialist lenders in that space. But also on, in my world, on the limited company side of things, what we've seen this year especially is what we're calling the professionalization of the market. So more and more landlords are using limited companies. The dinner party landlords, the amateur landlords, for want of a better phrase, are exiting to a certain degree. We're not seeing it quite as much as the headlines might suggest, but it is something that's happening where the accidental landlords, or those that have only got one or two properties, are looking to sell or exiting, and it's the more professional landlords that typically use limited companies in order to build their portfolios that are benefiting from that. Around about 30% of the business we've written this year at Fleet's actually purchase business, and when you drill down into it and look into it, a lot of that is concentrated into the limited company side of our business. So it's the professional portfolio landlords that are snapping up these properties. So I think as we go into 2024, that's going to be one of the big opportunity areas in the buy-to-let space, is limited company lending. And if you're an advisor that doesn't really do much of that, or you wouldn't class yourself as a specialist within the limited company buy-to-let sector, then my advice is to get genned up on that side of the market, because it is growing. And you're missing a trick by not focusing on that part of the specialist lending market as well, for sure. I think next year, though, it's going to be a tough year again, a bit like 2023 was. I wouldn't say it's going to be harder. I'd like to think as we're exiting 2024, the world is becoming, in terms of rates and things, a little bit of an easier place to be. But I think we've still got a period of time where interest rates are still going to be relatively high compared to recent history, which is going to have an impact on affordability and an impact on loan sizes, etc. So we're not quite out of the woods yet, but rates are moving in the right direction. Fleet have had a couple of rate drops over the last month or so. So things are moving in the right direction. It feels like we're over the peak of the pain in terms of rates. So I'd like to think that next year is a little bit of an easier ride in terms of affordability. But what a lot of brokers might experience, similar to us as a lender, is you might not be entering 2024 with quite as big a pipeline built up, of live cases in progress. So, we entered this year with quite a healthy, big, chunky pipeline from 2022. We're probably going to go into 2024 with a slightly reduced pipeline compared to Q4 last year. And I expect a lot of brokers are going to be in a similar boat because the summer was quiet. The market is coming back to life again after the summer break now, but it's definitely not as busy as it was this time last year. So I think pipeline going into next year is also going to be something that everybody's looking at and trying to bolster that and build that as much as possible.
Just a couple of points I'll come back on, if I may, Wes. With regard to the buy-to-let landlords, are you seeing this regional with them? Is it sort of like the southeast that you're getting the business from, or is it up north, or is there any pattern at all there?
Well, really good question, because when I first joined Fleet 2 years ago, well, just a little bit over 2 years ago, if you was to plot, if you was to put a little pin in the map with each of our transactions, there would have been a very noticeable southeast, south concentration. Obviously we were writing plenty of business in all the other regions of the UK, especially university cities, with student-let accommodation and HMOs and things like that. But there would have been a noticeable concentration in the southeast. But this year, because of the challenges around affordability and the high interest rate environment, what you're finding is a lot of the loan sizes required that would make the deals work in the southeast and the south are harder to obtain. So what we have actually seen is the professional landlords, especially, they're looking at the moment more so at the yield and the actual income return that they might be able to generate from an investment. So they are looking at some of the cities and towns in the UK where property prices are lower, but the yields are an awful lot higher. So if I was to put a little pin in the map for 2023, where each of the transactions are that we funded this year, you'd notice more pins compared to the last few years in the north, in the west, compared to the south and the southeast. So I think buy-to-let in general is a southeasty, south-focused market. You get landlords all over the country buying, but a lot of the times those properties would have been in the south. So you could have a landlord, based in Birmingham who's buying a property in London, for instance, or a landlord based up in Newcastle who's buying a property down on the south coast. You saw a lot of that. But now we're seeing that shift to the higher yielding investments rather than the higher property price investments where you'd expect that big capital return as well. So I think it's more about yields than capital return over the next year or two.
So if you have your pins ready for 2024, do you want to predict anything, or would you rather move on from that question?
No, it's a good question. We are seeing a noticeable increase in HMO, multi-unit block, student-let type accommodation, and that generally is what you will find in city centres. So some of the biggest cities in the other regions, Birmingham's, Manchester's, Liverpool's, Newcastle's, we are going to see more business in those areas of the country. So, I suppose another little top tip is if you're an advisor in those areas, then, speak to your introducers, your estate agents, people that are introducing business to you, and just put it on their radar that you do have options for investors that are looking for houses of multiple occupancy as well, because we are seeing more of that type of business in those areas of the country. But having said that, if rates continue to do what they're doing now, which is obviously come down, I don't think they're going to come down overnight. You know, there's going to be a period of time now where we're in a higher rate environment. But if they keep ticking down 10 basis points here and there, then every 10 basis points that we see chipped off of our products is another cohort of deals in the south and the southeast that then work again. So as rates come down, we'll see the activity in the south and the southeast go in the right direction as well. I mean, there is still business being done in these areas. It's just a little bit harder at the moment. So as those rates come down, it will become easier.
Yeah, I think it's all down to these swap rates again. And, you know, what you just said there, I was looking earlier and the swap rates have gone up again. So
Yeah.
it's you know, where's the crystal ball, isn't it? Whereas, you know, we can't really predict that, but we just have to watch this space on that.
Well,
But
they've gone up over the last few days because obviously the inflation data was probably not as low as people were expecting. But when we say they've gone up, I think we're talking about 20 basis points. Now, I remember this time last year where we were seeing swings of, you know, 60, 70, 80 basis points within hours over the course of the day. So I think with swap rates in general have kind of found that new baseline. So 5-year swap rates, SONIA swap rates are around about the 4.5% mark, and they have been for a while. So it feels as if all that volatility has gone, and we're in a much calmer environment where things aren't as up and down like a yo-yo. So at least that helps in terms of, you know, products not being pulled with very little notice and things like that. It helps in that regard. But if they're going to stay at this level for a period of time, we're still going to have an affordability challenge for a period of time. And obviously swaps are forecasting what base rate's going to do over that period. And if the Bank of England are to be believed, as we get to the back end of 2024, we should be in an environment where rates are starting to noticeably come down. So, yeah, if they're right, we've got another 12 months of hard work, and then hopefully it'll become a bit easier again.
yeah, I must admit, I'm picking that up, talking to people. We're looking sort of like 4% ish. So it'll be interesting to see what happens on that.
Yeah.
Just sticking with interest rates, then obviously we've got the Bank of England next month meeting. Again, from conversations I'm having, where it's sort of like tilting more towards an increase of maybe 0.25%. Have you got any view on that, or is it sort of like you're sitting on the fence with it?
It's difficult, isn't it? We're definitely we're at the point where it's going to start going the other way in the near future. Obviously, the inflation problem doesn't feel completely solved, but it feels like we're more than halfway there to getting over the inflation challenge. I know I've been reading the headlines recently. They're talking about, you know, oil prices have gone up a little bit. So it's the transport prices that have unexpectedly made was it yesterday? The day before? I can't remember. This week's inflation figures a little bit higher than the markets were expecting. So there's still a little bit of uncertainty out there. Obviously, the unfortunate events in the Middle East over the last couple of weeks have had a bit of an impact on those oil prices as well. So it's really hard to predict, especially because nobody's got that crystal ball, but especially with how crazy the world is really, with things that keep happening that people aren't expecting, and then that throws a little bit of a spanner in the works. But the main problem in the UK has obviously been the inflation challenge, and that feels like we're on top of it, and it's now definitely heading in the right direction. So if Rishi can hit his target by the end of this year to have inflation below 5%, we're obviously going to be in a much better spot going into next year in terms of base rate. If I was to put a bet on it though, Anita, I would put my money on another 0.25%, I think. Based off of this month's inflation figures, it feels like, you know, it's probably required just to make sure they're going to get the job done. And then hopefully in another 6 months, 9 months, we can start seeing it going the other way.
Yeah, you know, Wes, I agree with you.
Good.
Makes a change,
yeah.
Moving on then, Wes, any views on repossessions that sort of like is bubbling in the background? whether you can see that increasing. Have you seen anything? Have you got any figures, or again, not really anything happening on that front?
No, I have seen figures in the public domain from the likes of UK Finance that I think were up to this summer, like July kind of time, and no surprises that arrears impairment was on the up, but compared to previous downturns. So if we think about 2008, for instance, we're nowhere near those kinds of levels of impairment within our industry, and it's incredibly unlikely that we would see those kind of levels of impairment, mainly due to how robust the affordability stresses and affordability regulations have been since that time. Speaking about fleet, I mean, obviously I work on the sales side. I'm part of the sales team, so this is not something we generally get super involved with, but we do keep one eye on it. We get a monthly update from the people within our teams around our book, and without sharing stuff I probably shouldn't share on a podcast, I am probably safe in saying that there are no immediate concerns on our side of things, but it's definitely something we probably all need to be keeping an eye on, because with any downturn, there's inevitably going to be arrears and repossessions and things like that. We're living through a cost of living crisis at the moment, where it is very expensive just to get by day to day in the UK. We linked to this, slightly different subject, but also slightly linked, is obviously the fact that rents have gone up an awful lot as well over the last year or two, 10% growth year on year. So that worries me as well with private rental sector tenants. Can they afford to pay those rents if they're going up quite so much? So that feeds into our world with mortgages as well. Can the borrowers afford to pay the mortgages? I think what I'll say on this topic as a whole is there's been an awful lot of rigor around affordability over the last 15 years, and I think that will pay dividends now. We'll see less impairment within our lending, and also I think the nature of the society we live in nowadays is that there is an awful lot of outgoings that could be probably classed as luxuries that would be stopped first before somebody stopped paying their mortgage or stopped paying their rent. So, thinking of my own household, I hate to think how many TV streaming services I currently pay for, but it would be things like that would probably go first. The mobile phone tariffs will be reduced. The old thermostat would go down a little bit, I think, before people really get to the point where they're falling behind on their mortgages. So I don't expect there to be a big monstrous problem for us all to deal with within our sector through this downturn. But obviously it's something that we're going to see a bit of an increase in.
Yeah. But moving on, Wes, product transfers in the specialist buy-to-let space. Are you seeing an increase in this area?
So it's always been a tricky thing to have as a specialist lender in the buy-to-let world, because generally speaking, most of the true specialists that would do the quirkier transactions were funded or are funded by the capital markets, and that funding model makes product transfers quite difficult, especially if you've got a number of different funders, because those mortgages sit on a particular funder's book. And if you're looking to move them to a different funder's book, it is technically a remortgage more so than a product transfer. So the way that the specialist buy-to-let world is funded actually presents a little bit of a challenge in terms of product transfers. What we've done at Fleet, we have a solution that we call a loyalty product that's available for customers that are historic Fleet customers from when Fleet was also capital markets funded. So any broker that has an existing Fleet customer that sits within one of those pools potentially may have a loyalty product solution for that customer when their deal comes to an end. But having said that, any customers that we've onboarded at Fleet since the Starling acquisition in 2021, they do have a full true product transfer solution available to them. So the same as you would have with any other bank funded lender. So what the brokers listening to this today will be used to in residential lending world, it's a true tick a box, send a form in and the customer's got a new product without having to go through the full remortgage process again. You're going to see more and more lenders in the buy-to-let space, in the specialist buy-to-let space, having something along these lines. But the reason I think it's super important for advisors to think about the lenders they're recommending in terms of the product transfer proposition and their retention strategy as a lender, the reason it's important is a lot of the deals that we're placing today are on these higher fee, lower rate products. You may have seen these over the last 12 months within the buy-to-let space, where lenders have increased their initial completion fee in order to reduce the interest rate to get affordability to fit, to help with the affordability challenge. The issue you're going to have is if a customer's taken a product like that and they've really maxed out the affordability, if they get to the end of their 2-year fix or 5-year fix, whatever it might be, and they want to remortgage away from that lender, if they don't offer a PT and they're now stuck on an SVR, because they've had that affordability absolutely maxed a year or two before, there is the risk that they can't remo away to someone else. So it's really important that the lender that has offered that high fee, low rate product has got that product transfer solution on the shelf. So when they come to the end of that initial deal, they can then take advantage of a new rate that's in line with new business, rather than becoming what is in effect a mortgage prisoner. So it's definitely a hot potato topic at the moment in the specialist buy-to-let space. So just be mindful of that when you're looking at solutions for your customers. Does that lender offer something at the end of the deal? If so, what is it they're offering? How does it work? Am I inadvertently causing this landlord a potential challenge in 5 years' time by maxing out their affordability today with a lender where there is no option at the end of the 5 years, and then they're on SVR? So just be mindful of that.
Yeah, it's a good point, sir. Thanks, Wes. The other area I would like to just touch on is the green agenda. As I said earlier, we've basically seen mixed messages coming from the government regarding the minimum EPC ratings. What's Fleet's view on that, Wes?
Yeah, so over the last couple of years, it feels like it's been a subject that's always been discussed. So whenever we've done a podcast, or we at the NTE, for instance, recently, we're constantly talking about the legislation that's coming down the line, and the two dates that were being floated, 2025 and 2028. In terms of 2025, you have to have an EPC rating or C or above in order to advertise your property to let, and 2028. All existing tenancies would also need to have a C, EPC C or above. So no surprise that there's been a change there, because those dates, those deadlines were really looming, especially 2025, and it didn't feel like we had the detail and the clarity to really know what it was going to look like. So no surprise that the government and Rishi's kind of done a little bit of a U-turn on this. The way it's been positioned, and some of the headlines have said that it's been cancelled, it's been binned, it's no longer a thing. I'd be really careful with that. We've got a general election potentially in the near future.
Yes, yeah.
The whole lot could change again. It could be that the Tories resurrect this in a slightly different form after that general election as well. My thoughts are every landlord and every broker out there should be thinking about this and having the right conversations. There's a good chance that at some point in the future, there's going to be minimum EPC standards for private rental sector properties. So get ahead of the game, think about it now, think about the kind of work that might need to be done, get a plan in place, think about how you're going to finance that. Don't wait for it to actually physically become law if you can already get a head start on it. The challenges that if it was to actually come into effect, this legislation, then there's going to be challenges around availability of tradespeople, getting the work done, getting people booked in. Cost of materials will probably go up because of supply and demand. So there's all these things to think about if you leave it too long. So think about it now. There's lots of lenders out there that have got green mortgage products. So there are upsides. If you can improve the EPC rating, you might get a better deal on your mortgage rate. And then you've also got product features out there, a little bit like Fleet's cashback feature, where if you are an existing Fleet customer who's currently within a fixed period and you've took your loan from us since July of this year, if you improve your EPC rating from an E or a D up to a C or above, so this is a customer that's already with us, they've got a D or E rated property now, but they're going to invest a little bit of money to get it up to a C. Once that C or above certificate has been produced, then Fleet will actually send them a check for £1,000 just to contribute towards the costs. So if there's a little bit of work that needs doing, a couple of grand's worth of work, insulation in the loft, double glazing, whatever it might be, it could be that Fleet are contributing a little bit of a chunk of that towards that bill, just to improve the EPC rating. So it might not be imminent law, but it's still something that we're thinking about as a lender and trying to get creative with it to help, and do our bit, because at the end of the day, we've still got this deadline in the sand, this line in the sand for net zero by 2050.
Yeah.
So we still need to be working towards that as a sector, as an industry as well.
Yeah, I think we've all got to get together on this, Wes, and really sort of like think it's not all about the rate, is it? It's about what you can offer to make these sort of like planet more green all round. So I'm actually doing a fair bit of work on green at the moment. We're going to look at doing our own green hub. So yeah, interesting times on that one.
Definitely.
So from my point of view, Wes, I'm going to ask you to summarise in a couple of sentences how Fleet Mortgages can help our members.
Well, as you've probably already figured out, if you hadn't figured it out before, we are a specialist buy-to-let lender. So if you've got those professional landlords, those semi-professional landlords, potentially they've got a portfolio. I mean, our average customer has around about 12 properties. So that gives you a bit of a feel for the kind of customer that we generally deal with. And, every other transaction we look at is actually a limited company now. So it represents around about 50% of the work we do. So if you've got any professional, semi-professional landlords who are using limited companies to manage their portfolios, then think of Fleet. That's our bread and butter type of stuff. We've got some good rates, flexible criteria, a team of people that know what they're doing and know what they're talking about. So we can hold your hand, help you out, lead you through the slightly more complex journey when it comes to specialist buy-to-let. And then it's win-win for both of us. You guys help your landlords out, give them a good outcome. We get a bit of business on the books and everybody's happy.
Brilliant. Thanks, Wes. But just leaves me to say thanks for joining me today. What we'll do, if you have any questions, please either drop me an email or drop Wes an email. We'll include his contact details with the pod. And leaves me to say thanks for joining me and look out for my next podcast.
Thank you.